What's up, everybody? Welcome to the Stocks channel. My name is Corey, and today we saw another huge tech sell-off, even though we did see the Dow Jones closing higher for the day. And the S&P 500 just can't seem to go higher while tech is selling off. So we have a lot to cover tonight, so let's first look at the NASDAQ 100 QQQ ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so we did see a very bloody day indeed on the NASDAQ 100. We saw the QQQs going down 2.83%, which is an absolute routing for the tech sector. Now, during these volatile times, remember that the market is going to swing drastically in both directions. So as you saw with Friday's close, we did get a huge bounce off of this 297 level, and we had a very volatile price action day, as you can tell from this giant wick. As you can tell from today's candle size, we also had a ton of price action movement, and we're seeing volatility create larger and larger candlesticks. So if you look back throughout this ABC correction, you can see that the candlesticks are getting larger and larger, which means that we're seeing more price action swings and larger volatile percentage moves. So remember to protect yourself in these volatile markets and don't get too overly confident in either direction. Generally speaking, while the market's volatile, you want to remain defensive and you definitely want to pay attention to the trend. So on the QQQs, don't forget that we're still in a downtrend until we snap this resistance trend line. I'm going to jump over to a 1 hour chart, and I want to break down the price action in smaller time intervals to better understand exactly what's going on in these large candles. So we're now on a 1 hour chart, and I want to remind you of our Elliott waves that we're counting because we did have that ABC correction to the downside. It's possible that we did see the bottom of this correction at that 297 level. However, if the price action closes below 297, we will know that we're resuming into this bearish market and we're going lower, likely towards the QQQ levels of 280. Now, if you've been following along with my episodes, you know that after this correction, I am looking at a possible scenario that we're going up in an ABC to the upside and retesting this resistance trend line. This is likely going to happen whether we're in a bull market or a bear market. So even if we resume the downtrend, I'm still expecting to see a bounce off of these levels. This will be invalidated if this B wave comes down and closes below 297. So don't forget I'm on a 1 hour chart. So when I say closing below 297, I'm talking about a 1 hour candlestick closing below that 297 level. However, if we can stay at today's close and we can start bouncing off of that level going into tomorrow's open, it's possible that we complete this C wave and we come back up to about 314 or 315 and test this resistance level. If we can break out of this resistance, that will increase the probabilities that we're going back into a bull market and this correction is over. If we fail to break out of this resistance and we get rejected and start heading back lower, it's possible we're going much lower in this market. And then when we go back to retest 297, we might actually break down below it and start heading towards QQQ levels of 280. So in these scenarios, watching the price action at these levels is going to be very critical. So the most critical level I want you to pay attention to is this 297 level. If we come back down to that level and we do get a bounce off of that level and start resuming back higher, it's possible we come back up towards this resistance level at 314. However, the bad news with that scenario is we will have a lot more resistance that we have to break back through going back up to the upside to get up to those levels of 314. So the best case scenario for the bulls is that we start bouncing tomorrow, maybe even gap up over this 302 resistance area and start climbing towards that resistance at 308. If we can break over resistance at 308, we're then looking for a retest of the 314 breakout, which, as you can now tell from this chart, is also coinciding very closely with our resistance trend line. So the resistance trend line is downward sloping because we're currently in a downward trend. So in order to snap the bearish trend, we need to get a 1 hour close back above this trend line. So in a bullish scenario, we'll start bouncing off of this level to start wave C. We'll break out of resistance, come back down, retest that level as support, and then get a confirmation higher high close, which will take out this previous high here. That's the bullish scenario that we're waiting for. And if you want the best entry with the lowest amount of risk, you would buy somewhere on this bounce and you would have your stop loss somewhere below this support level. That's going to set you up for the best risk and reward trade possible, because you've already waited for the confirmation bounce to get an entry, which makes it less likely that you'll get stopped out of your position below support. If you set up your trades in this fashion, it gives you the highest probability success rate and it reduces your risk because your stop loss is just below where you just bought at. So you have less downside for potential infinite upside, even though you will usually lock your profits in somewhere in about a 2-to-1 risk reward ratio. Now in the bear scenario, I'm still expecting to see a bounce and possibly even a retest of this resistance trend line, but in the bearish scenario, we'll fail to break out, we'll possibly retest that resistance and fail yet again, and then we'll close and form a lower high yet again, and the market will continue in a downtrend. In this scenario, you can still short the market, but your stop loss would be on a break to the upside where you would cover your short position. So either direction, you can trade this market and you can be prepared to make money in either scenario. To the bull breakout, you're going to trade to the long side and set your stop loss below support. And to the bear scenario, you're going to short at resistance and set your stop loss above the resistance breakout. So you can trade this volatility in either direction and still remain profitable as long as you set up your risk reward ratios with a proper risk management strategy. Now there's still one more bear scenario where we don't actually go back up and retest that resistance trend line. It's possible we come back up and test this resistance around 308 and fail to form this higher high on the 1-hour chart and get rejected and then come back down and take out 297. If we take out 297, no matter how you look at it, there's going to be much lower prices in store for the triple Qs. So if we break down and close below 297, I'm automatically becoming more bearish and I'm looking for QQQ levels of 280. So with these scenarios, this is why it's going to be so critical to watch the price action. One thing I want to clear up, if you're on the Stocks Channel Discord, a lot of you are still asking a lot of questions about whether or not we're still in wave B. So to clear this up, let's look at this 1-hour chart. Every single candlestick on this chart represents one entire hour worth of price action. So every single hour, we kept closing lower and lower and lower. There's no trend shift because every hour that goes by, the price action is going lower. There's no way that wave B is going to be over with if we continue to close at lower prices. So if we're watching for a confirmation of wave C to start, we're waiting for a candlestick on the 1-hour chart to close over the previous low. So with this close, we close somewhere around 299.91, and we're looking for a close on an hourly candle above that level. So if we start forming candlesticks above these levels and we start heading back higher, that's going to be our pivot, and that's going to mean we likely bottomed out in wave A, and now we're watching to see for wave C how high we're likely going to go. So as long as the candles keep heading lower, that's a falling knife scenario, and it's showing that none of these support levels are holding up. Remember, on the 1-hour candle, you want to see the candlestick close, and you don't want to wait 30 minutes or 40 minutes to decide if it broke through a resistance level. You need to wait for that confirmation close because closing prices are the price action that mean the most. You could do something very similar on a 30-minute chart or a 15-minute chart, but remember that the higher degree usually carries more weight. So a 1-hour chart has more meaning to me than a 30-minute chart or a 15-minute chart. All right, let's jump back over to the daily chart and finish up this analysis on the triple Qs. So don't forget the critical support level that I want you to pay attention to is going to be this 297 level. Below 297, we become more bearish, and above 297, we still hold out for the possibility that we could bounce and retest our resistance trend line. Watch resistance levels at 307 and 314. If we break over 314, we're likely going to retest this trend line, and depending on when we test that trend line will depend on the price. It's going to be somewhere around 315 to 316. Remember, if we start breaking outside the trend line, we start looking at our bullish probabilities to start heading back up towards the 320s. Don't forget that the trend is still bearish. When the trend is bearish, we don't look to get too long in the market because the trend is still downward and the trend is our friend. Watch these moving averages, and as you can tell, they're still picking up bearish momentum and they're becoming more and more negatively sloping. So while the tech sector could be finishing up a tech correction, we don't know for sure until the price action confirms that the correction is over. Until proven otherwise, still assume that it's possible that the triple Qs are coming back down to this $280 level. All right, next up, let's jump over to the S&P 500 Spy Etf, and we saw Spy going down 0.5% today. Don't forget that the tech sector went down 2.83%, and the Spy ETF has over 30% tech sector. So it's going to be very hard for Spy going higher while tech is getting absolutely routed. So the price action closed below the 5 EMA, and we did close right on top of that support level around 381. Don't forget on Spy that we're also currently in a short-term bear trend. We know that because the 5 EMA is below the 13 and the 13 is below the 20. So that defines a bearish trend in the short term, but in the medium term, we're still holding up above a positive sloping 50 EMA. So this is not the time to get extremely bearish on the stock market as a whole. Without a doubt, we're seeing weakness in the tech sector, but we're still maintaining a medium-term bull trend on the S&P 500. So watch support levels at 381, the 50 EMA at 380, and then our gap close support around 377. If we break down below 377, there's one more support level I want you to watch at 374. Upside resistance is going to be 385, our 20 simple moving average at 387, and if we can get over that level, we're looking for a break of our resistance trend line. That's somewhere around 388, but remember that it is downward sloping, and the exact price of when we test that level will depend on the time. If we start breaking above the resistance trend line, we'll start looking at bullish scenarios yet again, because it means the downtrend is snapping and we could be going back into that bull market. All right, next up is the Dow Jones Etf, and I'm telling you right now that the Dow Jones is telling us a very important story. We saw the Dow Jones going up 0.95% today, and intraday, as you can tell from the wick on this candle, we were trading at brand new all-time highs. My price target on the Dow Jones ETF is up here at $322, and we were just about 30 cents away from hitting that price target. So just remember not to get too bearish on the stock market when the Dow Jones is forming brand new intraday all-time highs. There's still a lot of money in the stock market, and we're really just completing out this sector rotation. We saw a lot of money selling tech and selling healthcare in favor of the recovery plays like the industrials, financials, and energy sector. So that's why we see so much strength in the Dow Jones right now, even though we're seeing a lot of weakness in the Nasdaq 100. Don't forget that the S&P 500 can't go higher while the tech sector is going down nearly 3% in one day. The S&P 500 has a lot of technology sector in the portfolio, and it carries over 30% of the weight. So in the grand scheme of the stock market, we're really just going through a volatile sector rotation until it's over with. I won't expect to see volatility subside. So even though the Dow Jones was much higher, we still did see a volatile day because we did see a lot of selling into the close. But you can see with the trending that we're still picking up bullish momentum, and all of these moving averages are positive sloping, so it's not the time to be getting bearish on the entire stock market. Maybe it's time for you to consider going less tech heavy in your portfolio, but there's still a lot of sectors that are doing very well. So on the Dow Jones, watch support levels at 316, the 20 simple moving average around 315, and then our previous support level down here around 313. Our resistance above is going to be 320, and a price target which we still haven't broken above, which is 322. Next up is the ARKK ETF, and we see ARKK getting routed even worse than the Nasdaq 100, going down 5.82% today. The ARKK ETF has seen much better days, and we're sitting right on top of a support trend line around $110. If we break down below that support trend line, we could easily head back down to $105 or $97. To the upside, we're going to have resistance at 117, which was that previous gap fill, and we'll also have resistance just above there around 124. As you can tell from ARKK, we're in a very strong downtrend, and we don't want to get too bullish until we see a break of this downward resistance trend line. That's going to take a price action close of about 126 or higher before we snap this bearish trend. So as you can tell, there's a lot of tech companies in the ARK ETFs, and that's why we're seeing so much selling across the board, because these tech companies are getting beaten up the most. So don't forget to diversify, and don't be afraid to add some other sectors like the Dow Jones and the industrials into your portfolios. On the VIX, which is our fear indicator, we see the VIX going up 3.28% today, which really isn't all that bad. You can see the VIX is still trading below the resistance trend line, but we still do have a lot of bullish momentum in the VIX, which means at any point we could bounce off of these support levels and start seeing extra volatility enter the market. Remember, with more fear in the market, we're likely going to see more selling, and the correction is likely to deepen. But right now, we're not seeing the VIX forming higher highs on the daily chart just yet. We're holding up below these levels around 28, and we're still seeing lower highs on the chart. But that can change at the drop of a hat, so just be defensive and continue to watch the VIX. If it starts spiking back up into the low 30s and high 20s, we're still going to see very volatile sell-offs. In order to see the market cool off, we would really want to see the VIX start heading back to the low 20s, around 21.5 and 20. On the dollar, we continue to blast through resistance levels, and we see the dollar blasting right through this 92.26 level. As you can tell from this chart, the dollar is showing a lot of strength, and that could also start putting stress on the stock market if the dollar continues to strengthen. In the time being, the dollar is looking a little overextended, and it does look like it needs to cool off a little bit before it can continue to go higher. So we'll keep watching the dollar, But without a doubt, we can see a lot of bullish momentum picking up, and it does look like the dollar is ready to go back into a bull run unless we start blasting through some of these support levels and heading lower. With the strengthening dollar, we continue to see weak gold, and we see gold still hanging around the support level around 1685. If this support level on gold does hold up, we're looking for a price target above around 1761. However, if the support level fails to hold up, we're likely going to see a capitulation in gold, and we will go to much lower prices. On silver, we're also holding up on support, which is right around $25. If we see the support level hold up, we're looking to retest the 50 EMA around 2625. If we break over there, we're looking to retest our previous support level around 2656. On Bitcoin, we're going up 1.5% currently, and it does look like we're going back into a bull market. The price action is currently closing over top of a positive sloping 20 simple moving average for 2 days in a row. So that's the kind of bullish price action that we want to see, because it's likely that Bitcoin is going to predict the future in the stock market. Remember that Bitcoin is also a speculative investment, so if people are buying into Bitcoin, they're also very likely buying into the stock market, and we're not seeing market participants running for the hills quite yet. So right now, this is a bullish indication for Bitcoin as well as the stock market. So as long as we continue to see bullish momentum building up and we close over this 20 simple moving average, I'm looking for Bitcoin to head back up to 55,000. A break and close over that level should bring Bitcoin back up to a brand new all-time high, which is right around $58,700. Don't forget that if Bitcoin does go through a correction, we could easily come back down to the 50 EMA, which is currently at $44,100. On Amazon stock, we see selling going down 1.62% and closing right on top of our support level at $29.50. If we do break below that support level, there's one more support level below that we're watching at $29.05. Resistance levels are above at $30.33 and $30.90. On Tesla, we continue to see a lot of weakness, and we see Tesla going down today 5.84%. Tesla is getting absolutely routed lately, and this was expected ever since we finished this fifth wave. I did say that Tesla is going into a short-term bear market. So now that we're in this bear market, we're looking for when it could possibly end. So right now we're looking for Tesla to come down in 5 waves, and we are due for a bounce in the very near future. The question is, where is the fifth wave going to bottom before we see Tesla bouncing? So in order to watch that, we need to get out of this falling knife scenario. As you can tell, the price action is going lower day after day, and that's what defines a falling knife. The saying is, you never try to catch a falling knife, just be patient and wait to see where the bounce is going to come, and try to catch it off the bounce of a support level when the stock finally shows some strength. So right now, watch support levels at 557, and if we break below that support level, the next support level we want to pay attention to is going to be down here at 510. When Tesla finally does bottom and starts to bounce, it could bounce in a big way, which could also go hand in hand with the end of the tech correction and going back to brand new all-time highs on the S&P 500. So Tesla is a very important stock to pay attention to because it is one of those market-moving stocks. It's going to be hard for the tech sector to go higher while Tesla is basically in free fall. Watch upside resistance on Tesla at 618 and 685. On Apple stock, we went down over 4% today, and we're getting very close to that price target I have on Apple, around $114. Just like with Tesla, Apple is also going down in 5 waves, and I do have reason to believe that Apple could be bottoming around 114. It could also bottom before that level, and we could start heading higher soon, but this is a level that I want to pay very close attention to. Remember, Apple is a market-moving stock, so while it's going lower, it's going to be very difficult for the tech sector to go higher. So we really need to see Tesla and Apple put in a bottom and start bouncing off of one of these support levels very soon. The good news is I have them both completing a 5th wave, which means they're both due for a relief rally after this wave completes. So watch for downside support on Apple at 114, and upside resistance is going to be between 120 and 124. There's going to be a ton of resistance above for both Tesla and Apple, so even on a bounce, it's not going to be like it's going to brand new all-time highs in a month. So be patient on this market and let the volatility subside, and we need some of these tech giants to finally find support and start building a foundation and a support base to start heading higher from. On the financial sector, we went up 1.28% today, and we're still in a very strong bull trend. The financial sector is one of those sectors that I've been telling you is still showing a lot of strength in this volatile market. On industrials, we went up 1.05%, and again, we still have a very strong bull trend. The industrials have also been one of those very strong sectors during this sector rotation. On the energy sector, we went up 0.19%, and we're still in a very strong bull trend. On healthcare, we went down about 0.25%, which is good news because it shows that the selling is finally slowing. We did close above the 5 EMA for 2 days in a row, and we did get a volatile day, but the price action only went down about 0.25%. So while we are still in a bear trend, it could be a sign that selling in healthcare is slowing down, and we could be due for a reverse and start going back into a bull market. So going back to the S&P 500 to summarize all of this crazy price action, you can still see that this is still a very volatile market that is mostly being led by a tech correction. We still see a lot of strength in the sectors like the financials, the industrials, and the energy sector. We see a little bit of weakness still in the healthcare sector, but the majority of the weakness is still coming from the tech sector. On a day that the Nasdaq 100 is going down over 2.8%, it's going to be very hard for the S&P 500 to go to new all-time highs. So once this tech correction is finally over with, it is possible we'll see the S&P 500 finally climbing back up to brand new all-time highs. Remember that our previous all-time high price target was 393, and we never closed above that level. So we're still watching that price target as an all-time high possibility, but we need to snap this downtrend, and we need to see the tech sector start showing some strength. So don't forget about this critical 297 level on the triple Qs, because if that level does break down, it means we're going much lower, which is also going to drag the S&P 500 lower with it. On the Spy Etf, watch the 50 EMA very closely, which is right around 380. So there's still a lot of critical support levels that we need to pay attention to, and if we see the price action breaking below these levels, we need to remain bearish in this market until we snap the downtrend. So stay disciplined and stay patient, and if you're not doing well in this volatility, it's okay to walk away from trading and come back in a couple of weeks when it's all over. So let's take a quick look at our hot stock, which is Lockheed Martin. We saw Lockheed Martin going up 0.3% today, and it still keeps hitting our price target about 344 and then selling off. This is a great opportunity for traders to take advantage of the volatility because you're practically getting entries and exits on this hot stock almost daily. Don't forget to watch the support levels around 339. If we break below there, you're looking at 333. The upside price targets are still 344 and 348 in the near term. If you need help in this volatile market, come check out the Stocks Channel Discord. You can find out how to join the Discord server by clicking on the link in the description of this video. So thanks for watching, everybody. Good luck out there, and remember to stay disciplined. And as always, I will see you in the next episode.